Hey, what's up, everybody? We made it to the weekend. We got Memorial Weekend starting, and I wanted to wrap up what we've seen in the markets this week. So, in the economy, what we're really looking for is this bull case scenario where we get three main things the market wants. So, right now, inflation's a trouble. And then it's like, okay, price has gone up, but we could always borrow money, but borrowing costs are high. And then the economy's kind of slow. So we want trade deals mainly along these tariffs that are causing inflation. We want the Fed to cut rates where we're really seeing high borrowing costs. And then we also want these tax cuts and deregulation. That way people have more money to spend and put that into the economy. And something that we're seeing right now is that the daily sentiment index right here is what I got pulled up. This measures how optimistic or pessimistic investors are towards a particular market. And what we're seeing is that we've seen the largest swivel in the shortest amount of time uh, since 2002, pretty much when they've been started tracking this data. So we went from really pessimistic to really optimistic very fast. But think about that bull case that we got, that we want. It hasn't really changed much, right? We still want these tariffs lower, so inflation, the rate at which the price of goods and services increases goes down, so prices increase less. We still want these borrowing costs to go down, mainly through the Fed cutting rates, and we want these tax cuts. So nothing's really changed yet. But we went from really pessimistic, well, optimistic to pessimistic after the announcement of these tariffs and everything, to really optimistic again, and these are still issues. Negotiations aren't getting better. This is actually the worst week since April in the stock market, and we really got some news today from Donald Trump. He's back at it again, and it was two main Truth Social posts. So he attacked two people pretty much, and the people could be seen as a group. And the first group will be the European Union. So Trump made this Truth Social post right here towards the European Union, which is 27 countries, that we run a $235 billion deficit with, and they give us a lot of pharma, cars, wine, and perfume comes from Europe. Well, he made this post and said, starting on June 1st, 2025, I'm recommending a straight 50% tariff on the European Union. There's no tariff if the product is built or manufactured in the United States. Thank you for your attention. Wow, so agreements must not be going, negotiations must not be going very well for him to have to announce a double of what they were before he lowered it to the 10% baseline. That's kind of tough. And why is this tough? Europe is one of the largest trading partners the US has. And then there's another one on this list. Let's go back. This other party that Trump attacked on Truth Social, I guess he kind of attacked him in a way. Well, I guess two people from this, or three people. Tim Cook, Apple, and where are iPhones made? In China? And I guess kind of India. So four people saying that a tariff on Apple if iPhones are not made in the US, not in India. He wants them made in the US, made and sold in the US, or you get a 25% tariff. One of the most valuable companies in the world. And this really leans towards China. And then with all the China mess going on, they're thinking about diversifying their supply chains and factories, and we're checking out India. But Trump just dialed back and was like, hey, if them ain't made and sold in America, 25% tariff. Now, there's a couple of different things Apple could do here. They could begin building in the US. They move their complete supply chain and assemblies over to the US, and it costs a ton of money. Or they just eat that cost because it would be completely less. Think about the American labor. and the startup costs and everything that will be associated with moving an entire supply chain over to the US where wages are typically higher. We could see an iPhone price triple in that case, 3,500, 4,000 easily if that were to happen. So they're better off just continuing to sell where they can and just paying the 25% tariff. But what does that mean in the short term? Higher costs, inflation. So instead of that bull case that we want, we're not actually getting there. But what does the market think about this? Well, immediately today, upon trading, we've seen a market dip along the major stock indices. We've seen quite the dip, but is retail thinking that Trump is bluffing in a way? Because they immediately bought the dip and they were probably thinking of this daily sentiment index right here, where, all right, well, last time tariffs were bought, we seen stocks come back to near all-time highs again pretty quickly. So we've been here before, Trump. So they kind of bought the dip a little bit. Hey, maybe this is just news in the short term and he reduces tariffs again like everywhere else. So it seemed that everybody didn't take him, well, a lot of participants in the market didn't take Trump serious and kind of bought that dip. Buy the dip, baby. And then I noticed towards the end of the day, there was more so a sell-off. So this tells me something. Actually, this makes me think something. Retail is buying the dip in the AM. Hedge funds are selling in the PM right before market close. Or anybody could be selling, but usually funds sell later in the day. And what did we see gold do? We seen gold do pretty well. We actually seen Bitcoin drop. Although markets are dropping, I mean, the VIX is kind of going up a little bit, but not to quite the same levels we've seen. But I mean, it's spiking a little bit. Treasury bonds down still. And this is the 10-year. We've seen Apple take a nosedive. It kind of bought the dip on that and it consolidated. And I thought this was interesting. QQQ NASDAQ 100 bounced off this line I made in a few videos back. We made this one together, I think. So retail thinks Trump is bluffing. Funds are kind of unloading, and we've talked about how they're loading up on hedges and just hedging this market because we've been here before. Now, where are people really going if they're selling stocks? There are a few different safe havens. We've got the gold for one. We see gold's doing pretty well. I mean, some people say Bitcoin, but it looks like Bitcoin's kind of traded down on the day. But it has reached new all-time highs. So has gold, though. So gold seems to be the more sufficient play here. Japanese yen, because the treasury yields for Japanese treasuries, I believe it was like 3%. And then once you adjust it for foreign currency and exchange risk and everything, that's paying higher than these US treasuries are paying, even with the 30-year at 5%. And then that's how the carry trade unloads. The yen is where a lot of money is created because of those artificially low interest rates, and then borrowing to buy other assets. Whole mess with that, really complicating. And then also the Swiss franc. And in a way, I guess US treasuries. We've seen US treasuries kind of go down a little bit. Well, at least the yield. So in that case, bonds would go up. Yeah, we've seen TLT 20-year bond kind of go up a little bit. So the yield went down. What about these 30 years? I mean, this 30 years is still pretty high though. But it went down a little bit. Down from that like 5.16 or 5.13 it was at earlier. Like at its all-time high. That was crazy. 5 years risk-free for 30 years. Wow. So watching all this play off, and also the Swiss franc. Let's look into this. Let's go to Google. Why is the Swiss franc considered a safe haven. There are many reasons why the Swiss franc is it's one of the most stable currencies, proven legal, finance. Built on privacy. All right, maybe we need to go to ChatGPT for this because I want to break it down. I want to get deeper into the weeds here because that's how we figure this stuff out. All right. Why are investors I'm humble enough to do this together. So I understand three of those in this equation, but not so much the Swiss franc, due to a combination of Switzerland's economic resilience, political neutrality, and the currency's historical stability. Low inflation, hovering around 0.3 with the rates. So rates are still low. Low debt to GDP around 38%. Resilient economy. Global reserve currency status for central banks worldwide. Central banks. Appreciated approximately 9% against the US dollar, making it the most significant run in April 2025. All right, so Swiss franc, political neutrality, low inflation, strong banking sector, small economy. And Swiss appeals as a safe haven stems from the. All right. So pretty much the same deal as with Japan. So that's interesting. And I seen this article. So it was talking about how with these fast moves in the market, this could be because of a reason. And it makes me think about this recession risk on the table, because if we're expecting a recession, just consider this part. So the article was talking about how with, let me pull it up so I could say it exactly how I seen it. So with more money in certain stocks or index provides more because there are more market participants trading, and that makes faster pricing due to as news coming out and these traders watching looking for an opportunity. It makes it really event driven, so when things happen it gets priced in quicker, so then these markets are more efficient. So in this case, that could be why on that daily sentiment index showing why it went from so bad to, or so good to so bad to so good so fast, just because more people are interested in trading. How many people have Robinhood on their phone and are learning about options and all of this other stuff, aside all the funds and central banks and governments out there, all these insurance companies, all of these other market participants out there, and now retail buying the dip, learning how to do all of this stuff on their own. I just thought that was interesting to consider. But that makes me think, with everything happening faster, this could be more of a market cycle we see ourselves in, like this cyclical move to where it's up and down, up and down, up and down. And as these stocks are up higher, that allows negotiations to be better from Trump's point of view, because if stocks are doing good, American assets are doing good, American people are likely to benefit from that. And then when American people are doing better, I could, from Trump's perspective, I could see why he could be a little bit more harsh in his negotiations with other countries with these tariffs raising costs, because Americans have a little bit more money in their pockets. So they're hurt, but they're hurt a little bit less or distracted by the green chart going up with the stocks. So they say, some people are saying, all right, as stocks go up, Trump trades harder. or negotiates harder. And as they start falling, that's when he comes in with the reductions or kind of peels back or, yeah, that. Now, I thought it was interesting with this Apple thing going on because if people think the cost of iPhones are going to go up, like I said, we've been here before. They're going to try to front run these tariffs and buy iPhones. And the next time Apple reports earnings, I believe was August 7th. So that should give their numbers right now a good little boost. And this is conveniently right when all of these companies are coming out with bad earnings or slow forecasts, lower forward guidance. And that just conveniently happens right now. So I'm interested to see how this moves. Susan Collins doesn't see a reason to cut. She came out today talking about that, and she said due to inflation pressures from these tariffs and a strong labor market still persisting. And then I went out to September 17th meeting, and it looks like the odds of a rate cut in September, which is where everybody was expecting us to get our next cut. We're skipping the new next two meetings because it just seems really unlikely, and the Federal Reserve members keep mentioning like, hey, like we're not comfortable to cut yet. So they're just pushing it back, and some people are even discounting the odds of us getting a cut the rest of this year. We might sit still for the rest of the year and then cut on January, or what some people are thinking. But September was the next big catalyst to watch for, and it looks like the odds of that are kind of diminishing away. So it's back to that bull case we're watching. We want trade deals. It doesn't seem like they're getting any better. We want the Fed to cut. That's kind of going away. And these tax cuts and deregulations, that could probably cause some economic expansion. But at the same time, that runs a larger deficit of like 2.7 trillion or whatever over the next 10 years. A larger deficit at the same time as economic expansion, which is a form of inflation expectations, and the need for more money. The government will have to borrow more money, issue more debt via treasuries, and to entice people, yields go up. That affects borrowing costs. So all of this is interesting. Those borrowing costs, we talk about it in pretty much every single video, how that could affect the broader term economy. Just to kind of wrap it up, consumers are impacted, businesses are impacted, governments are impacted, banks are impacted, spending could slow down, and that is not good for asset values. So let me know what y'all think about all of this. It's been a crazy week. I hope the weekend's a lot better for you. I'd imagine with Memorial Day coming, I wouldn't be surprised if we get some crazy news out. April 2nd, 2.0. Tariff 2.0, Trump, I guess like 6.0. We'll see. Y'all have a good one.